All right, everyone, buckle up because today we're diving into the world of Braze, the customer engagement platform that's been making quite some waves on the NASDAQ lately. So what's all the fuss about? Well, Braze has been in the limelight due to its latest quarterly earnings report, which brought both good news and some results that had investors scratching their heads. First off, Braze did manage to beat market expectations, posting quarterly earnings of 7 cents per share compared to an anticipated 5 cents. Their revenue followed suit, clocking in at $162.06 million versus the expected $158.66 million. So far, so good, right? But hold on, the plot thickens. Despite a solid performance in this quarter, Braze ruffled a few feathers by tweaking its full-year guidance for earnings per share. Initially, the company had set a more optimistic EPS range for FY 2026, but they're now singing a different tune, forecasting earnings as low as 17 cents per share. This comes alongside a revenue guidance upgrade for FY 2026 to the 702 to 706 million range. While increasing revenue is generally a cause for celebration, the sharp drop in projected EPS had some investors stepping back with a raised eyebrow. What's driving these mixed signals? A strategic acquisition spree could very well be the culprit. Braze recently incorporated OfferFit, which, while a long-term strategic win, hasn't yet settled into the company's operational framework. Layering in OfferFit's costs dampened the operating margins slightly, and while this acquisition bodes well for future product innovations, birdwatchers in the investment world started to grow cautious. Now, let's sprinkle in some industry insights. Despite EPS concerns, the company seems to be muscling its way through these growing pains with resilience, citing broad strength in several industries and a confidence-smearing picture in trade conditions globally. Bill Magnuson, co-founder and CEO, didn't seem downbeat. Instead, he shared optimism because Ed McDonnell, a new head honcho of global revenue operations, joins Braze, bringing a glittery resume of achievements from the SaaS world. But not all numbers were sunny. The dreaded word in investor meetings, retention, popped up. Braze's dollar-based net retention took a tumble, recorded at 109% this quarter from 117% last year, meaning their existing customers are still spending, but not as rapidly as before. Yet, with 10% more customers and a 24% rise in high-value annual contract figures, there's a canvas of positivity for the future. In summary, today's headlines tell a tale of dual narratives. Braze shows up stronger today, promising a bright revenue boost for tomorrow, but with profitability guidance that's taken an unexpected turn. Investors have some food for thought, with eyes peeled for next quarter results as they decide whether Braze's vision holds the gravity necessary in the tech constellation. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.